So how we made that? We first of all period 0, then this is period 1, 2, 3, 4, right? This is year 1, this is year 2. Let me just change the color so that you may not be confused, right? So that you may not be confused, I'm just going to change a color here. This is sorry, this is year 1 and these two payments belong to year 2. So 0 period, so that is company issued and received 642808. So the value was 500,000. Company says 462,808. The balance is 37192, which is discount, right here. So what is the interest payments? Interest payments are based on the face value. Face value is this one, so it is 5%. 5% by 2, answer is 2.5%. So when you multiply this with 2.5%, or you just multiply this here, 5% multiplied by 6 by 12, answer going to be 12,500. So interest payments are based on coupons, so these are same. Now the interest expense is based on the market value or bond value. So what is the bond value right now? Bond value right now is 426,808. So multiply, and this is a 6%. So 6% multiplied by 6 by 12, answer is 3%. So here, so 3% multiplied by this amount. So this amount came from 3% multiplied by 462,808, right? Answer is 13,844. So the difference is between interest payment and interest expense. So interest expense is equal to interest payment plus discount, right? If we want to find out how much is the value of discount in interest expense, so yes, rearrange this equation would become interest expense minus interest payment, right? So if you see the difference here, difference is 1,384. So that discount is going to be added in the value of the bond. Why? Because at this, the discounted price eventually will go up, and at the maturity it will be equal to the face value of the bond. Okay, so this discount is added up. So why? See, when you add here 1384, it will be 464,192. So the next is again, so where this came from, it is equal to 3% multiplied by 464,192. Answer would be 13,962, and the difference between them is 1,426. This would be added here, and you add this 1426, answer would be 465,618. Similarly, where this 13,969 came from, it is 3% multiplied by now 465,618, right? So difference between this interest payment and interest expense are 1,469, and it would be added here. So if you see, discounts start decreasing and the value of the bond start increasing. So where this 467 and 087 came from, you add the discount here, 1,469. The last one is Where this 14013 came from, it is the bond value, which is 467 multiplied by the market rate. Market rate for 6 months, 6 by 2, which is 3%. So 3% multiplied by 467,087. So the difference is this 1513, and that would be added in 1513. So this is the bond value at the end of year 2, or at the end of period 4, or at the end of 2016. So this is how we make amortization table, right? So what would be the entries for December 2014? So December 2014, the entry would be when you issued the bond. Value would be you receive cash, and then discount, and then bonds payable, right? So cash, discount to bonds payable. Now account for this interest. So June 30 you paid the interest, right? So interest payment is through cash. Actually you pay how much? This interest payment, but your interest expense that will go to income statement will 13884. So what is the entry? Interest expense to discount to cash, right? So basically you decrease the discount, that's why decrease in expense is basically credit. Increase in expense means debit, and decrease in expense means credit, right? This would be the entry. And what about the entry for 2015? The payment is going to be 31st, recorded as 31st. This would be here. Why not here bonds payable? Because the payment is on 31st, which is included in fiscal year. If the payment is on January 1st, then here would be bond payable, right? So this is just one tricky question that I just mentioned. Okay, here. And what about this period? It's the same, you can just continue with that. Okay, now the partial interest amounts. So I have pasted an illustration here, just read it by yourself. We have already been given this amortization table, so just you have to make the accounting year ends at 31st. You have to find out the amortized discount and for 4 months and the accrued interest. I'm just going to show you the answer here and just match your answer accordingly. Here it is, interest expense to discount on bonds, right, to interest payables, right? Now we will start about accounting for bonds payable issued at premium. So premium means when the company receives cash more than its issuing value or face value, right? Okay, so let's understand it by an example. On January 1st, 2014, Southwest Airline issued 100,000 of 9% 5-year bond where the market rate is 8%. How you know that this is premium bond? Because you are paying higher, the company is paying higher, and market rate is lower. What was the tagline? Tagline was that when coupon rate greater than the market rate, then bonds are issued at premium. So the proof is that they received more than issuance, right? So company received this value, right? Cash is received. Answer would be cash 104,100, right? And company need to pay back the money. How much? 100,000. So the excess amount is called premium, and premium is recorded as credit. Increase in premium means credit, right? So it is the opposite of the discount, which means it start decreasing from the interest payments, which means interest expense. So in that case, our interest expense will be lower than interest payments. Why? Because the the value of the bond must be equal to the maturity value at the end of 5 years, right? It start to decrease. In case of discount, it has to increase to the maturity value. So the accounting equation is not disturbed. Why? Because we have cash, which is 104,000. Liability, we have to pay this one, and this is also our, we treat this premium as a reserve, or because it's also payable, we receive in advance, so we'll adjust it into paying back our interest. So how we write it on the balance sheet? We write it on the balance sheet as bond value plus the premium. In case of discount, we write it down here in negative, right? But here is a plus. So bond value right now is more than issuing balance. So it means in after 5 years, this will decrease to 100,000, right? This will decrease. Okay. So let's talk about how we calculate the interest payments and interest expense. So remember, interest expense is always based on market value, and interest payments are always based on coupon rate or stated rate. So interest payments is calculated as 9% annually, which is 4.5%. It's 9% semi-annually, which is 4.5%. So 4,500. While the interest expense is based on market value multiplied by this market rate, 4% annually, semi-annually, or 8% multiplied by 6 by 12. So did you notice something? Here interest expense less than interest payments, right? Did you notice something? The interest expense that would go to income statement is lower than what we actually pay. So it means what we have received in excess, we will retire this. This is for 5 years. We will slowly, parts of this 4,100 will going to be retired slowly, and we're going to be adjusting it into our interest payments. So that's why our interest expense are lower, right? So at the end of the year, maturity year, the value of the bond has to decrease to face value. In case of discount, it will increase to bond value. In case of premium, it will decrease to bond value. So 4,500 came from, you multiply this 100,000 with 4.5%, but these values, they depend on the book value or the carrying value of the bond. So 104 100 multiplied by this 4%, 103 764 multiplied by here 4%. So this came from here, and at the end, this is the plug figure here, because at the end of the maturity, it has to be equal to 100,000.